Understanding stock market indices. You probably heard names like Dow Jones, the NASDAQ Composite, or the S&P 500, either in financial statements or in conversations. These are merely a measure of the performance of the group of stocks. They can be used as indicators to measure how a country's economy is moving. The major indices in the US are the Dow Jones, the S&P 500, and the NASDAQ Composite. So the Dow Jones was founded in 1896 by Mr. Dow, and he named it after his business partner, Edward Jones. So it's a composite of 30 the 30 largest traded stock in the US. Consists of Apple, Microsoft, Tesla, etc. So it tracks those 30 stocks, and these stocks are market cap weighted. So market cap is just a fancy way of saying the value of the company determines how much stake it takes in the Dow Jones. So for example, if Apple is worth $1 billion and the Tesla is worth $3 billion, so Tesla will take a much larger stake in the Dow than Apple. Also, a $10 million market cap stock would not have an effect on the Dow. A price change in $10 million market stock will not have an effect than a $50 million market cap stock would on the Dow. So it's all market cap weighted in the Dow Jones. The next one is the S&P 500. The S&P 500 is a global standard of measuring how the US economy is performing. So it tracks, why is a global standard is that unlike the Dow, it tracks 500 of the largest US companies, and it has become a standard. This is, I've ever heard a saying that you beat the market by 10%, or the market is down by 20%. The S&P 500 is what they refer to as the market, literally. So as an investor, if you're investing in individual stocks and your returns supersede how much the S&P 500 returns, then you effectively beat the market. So majority of people do not have access to invest in this individual market, as you know. So there are ETFs that mirrors the performance of this S&P 500. You can get the BOO, the VII, the SPF. So those are ETFs that if you purchase, it's like purchasing the S&P 500 because they mirror the performance. So when the S&P 500 kicks out the market, a stock that doesn't meet the market cap criteria of the S&P 500, the same ETF will sell the same stock. So it's mirroring the performance of the S&P 500. The last but not the least is the NASDAQ 100. It's a home for tech stocks, bio company stocks. It's very growth oriented. So that's why its volatility is very high. It tracks anywhere between 100 tech stocks, and there are so many listed companies on. At the time of this recording, I believe it's around 2,000 stocks listed on the NASDAQ Composite. So those are the difference between the three largest composites in the US. As always, my friends, if you found value in this video, comment, let me know. I'll see you in the next one.